Welcome to the monthly market report for January 23. It's a brand new year. There's new possibilities, new opportunities, and we're going to talk about some of those in this video, but let's start with the realities of last year. 2022. The 30-year fixed rate in this country doubled last year. We started out at 3.2 back in January a year ago and ended up right at 6.4 as we wrapped up the year. I've never seen a year where mortgage rates doubled. Never seen as rapid a rise in mortgage rates in this country ever. All of that certainty has impacted the market. Largely, it's impacted folks psychologically, and I think it's important to understand why that's happening. And that means understanding the relationship between the 30-year fixed mortgage rate and the 10-year Treasury yield. And it's all about understanding the spread. Everything is about the spread. So let's just go back to the years 2000 through 2021. So literally the last 21 years. And if we take a look at the average 10-year Treasury, it was about 3.49-ish, thereabouts. The spread there being about 1.79. And in turn giving us an average mortgage rate of 5.28. So if you take the Treasury and you add the 1.79, you get the average mortgage rate. And that average over the last 20 years has been 1.79. Now, over the last couple of years, that number has been fluctuating. But in the last year, we've seen that spread rise to a point where today, the 10-year Treasury is at 3.69, and the spread is at 2.79, which is putting mortgage rates at 6.48 right now. So let's just call it 6.5. So that spread has widened dramatically over the last year. If that spread were normal today, we'd see an interest rate of just about 5.5. So looking at the snapshot of what's happening right now, the spread between the 10-year Treasury and the 30-year fixed mortgage rate is a measure of volatility and panic. That panic is starting to subside, which is good news for the long-term interest rates. We've seen a little bit of relief over the last 6 to 7 weeks or so, and a couple of chip-ups in the last few weeks, but certainly up and down, and still a little bit volatile right now. But look, if you look at the spread over the last year, we've started in January of last year and the spread's been rising as panic entered the market. Now, I'm going to just add a line over here. The first part of the year, we saw folks getting more uncertain about the economy. Things were happening and panic entered into the equation, and that changed our world economically. Then, around June last year, I don't know if you remember, but the Fed came out and said, hey, we don't have a solution for this. We don't know how to control the market. We're going to have to do a reset. And again, we saw the panic go up. Then we come to the end of this past year, we start to see the panic subsiding a little, and suddenly all of the experts, the economists and the Fed, start saying that, hey, maybe the peak of inflation was behind us. Now, I'm not here to say it's all about inflation, and we need to not do anything about that. I think there are very real things that we can do, but the bottom line is that there's still about a 1% difference between where that spread sits today and where it has sat historically. So as we do a better job of taking panic out of the marketplace, we'll see that spread dropping even lower. Because here's the bottom line. There are a couple of perspectives out there that I believe are worth noting. The first one is from Lawrence Young, chief economist and president of research for the National Association of Realtors. So Lawrence Young says, the upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. Additionally, one of the premier thinkers in the mortgage business right now, David Stevens, who was the former Assistant Secretary of Housing, he said this, look, be advised, this may be the one and only window for the next few years to get into a buyer's market. And remember, as the Federal Reserve data shows, home prices only ever go up and always recover from recessions, no matter how mild or severe. Long-term homeowners should view this market right now as a unique buying opportunity. And it is. This is an opportunity. We haven't seen this over the last couple of years. And I think there are things that stand in people's way. I get that. And those concerns have merit. And I want to address those. But I think if we miss this opportunity, we're missing what this market can bring to us. It is a buyer's market right now. One of the concerns that we had last year was home prices and the forecasts that are out. And first off, just let me say this about forecasts. I understand that there's only one thing that we can be absolutely certain of, is that the forecasters are not going to agree. However, this is a look at the forecasters that I follow. And they do. They go anywhere from depreciation of 5% to appreciation of 5%. But the important thing to note here is that we don't see any of these reputable forecasters calling for a free fall in prices. Not in this housing market. One of the interesting things that has been published recently was an article in the Wall Street Journal where they looked at home price appreciation before the pandemic and after the pandemic. And if you look at the market before the pandemic, from the fall of 2017 up until the spring of 2020, we had appreciation of about 12% in that 2.5 year time span. But if you think about what happened in the 2.5 years going into this fall, since the beginning of the panic, what do we see there? A massive amount of appreciation across the country. Throughout real estate, residential real estate in America, 38% rise in equity. So would it make sense that in some markets and in some cases, we would see a little bit of a comeback? Absolutely we would. But again, not a free fall in prices. Maybe some of them have said things like that, people in the media, maybe people on YouTube, places like that. Ignore it. Another piece of misinformation that's coming from people think that prices of every home out there are being reduced right now. And that's simply not true. If you look at this, the share of homes having their price reduced, going all the way back to 2021, look at this graphic. The most recent information that we have right now from Realtor.com, in November 2022, just over 1% of homes had a price reduction. So again, not a free fall, not a situation where we're seeing every home, or a great majority of homes for that matter, having their prices reduced. Just a slim piece here and there. Now look, one of the questions that I would certainly put on the table right now is this question: have home values hit their bottom? And if you isolate the last 4 months that have been published, what we see is that in each case, that depreciation peaked in August. Now, I'm not here to say that we're out of the woods, but what I am here to say is that home price depreciation is not in free fall. I might even go as far as to say I'm not seeing it drop and then continue to drop. We may see a little bit here and there, but not a precipitous fall, not a massive decline in home prices. One of the things I think about a lot is what has been said recently about the housing market, and that it's frozen, that things are slowing down to a standstill. Well, here's the bottom line. The December existing sales report, i.e. the most recent one, shows that over 11,000 homes sold every single day in this country in 2022. The proof of that is in the math on the screen. Just over 4 million homes in the existing home sales report. Divide that by 365, it's just over 11,000 homes every single day. So, no, not frozen, not by any stretch of the imagination. In fact, let's just use the analogy of a shower, for instance. If for the last couple of years, you're in the shower, the water was nice and warm, it was a great shower, it was at that point where it's just not too hot, not too cold, just warm enough where you can literally take an hour-long soak. But right now, that's not what's coming out of the spigot. Maybe it's noticeably cooler, I get that, but it's not frozen, not even close. FYI, that means that 8 houses sold in America every single minute. Again, here's the math. If you take those 11,000 and divide it by 24 hours a day, 467 an hour, divide those by 60, you get 7.8. So essentially we were selling 8 houses every minute last year. So if somebody sits down with you one day and says, has a 10-minute conversation with you and is complaining that there's nothing selling in the market, you can sit down and tell them that literally, while they were speaking, 80 homes got sold. I think sometimes it's important to question the narrative. Now, we also to remember that financing has come a very long way in the past few years. I think that it's critically important right now to remember that there are real options coming out of the mortgage space at the moment. Adjustable rate mortgages, rate buy downs, 2-1 buy downs, even seller concessions that applied to a buy down. That's hugely advantageous to those looking to buy right now. In fact, I think on that note, might be time for a few quotes. Let's take this first one from the Urban Land Institute. They say, the risk of ARMs and adjustable rate mortgages were substantially mitigated by the regulatory reforms that were put into place after the 2008 bust. Today's adjustable rate mortgages is not the risky product that it was of 2008, or even the previous bubble version. ARMs are no longer something to fear. In fact, they could actually help borrowers, help to save them money, remove barriers to home ownership. There's a lot of options. Let's have another quote. Another one, this one from the Real Estate News. Temporary rate buy downs are a hot trend for mortgages as borrowers face higher costs for home loans. Some buyers are exploring alternatives to traditional mortgages in a period of rising interest rates that is expected to continue into 2023. Buy downs are a less costly alternative to a traditional fixed rate mortgage. So, whether it's a buy down or an adjustable rate mortgage, the point is that there are options outside of a traditional 30 fixed. Alrighty, so I'm going to wrap things up here, but I'd like to thank you first of all for watching. I'm very grateful that you've invested your time into understanding what it's going to take to master the opportunities that this year is going to bring. So, Happy New Year, and I look forward to seeing you back next month. Cheers.